In the hot seat this evening is Andrew Canter, the CIO of Futuregrowth. Andrew, thanks very much for your time. Well, the bond market in South Africa, we were chatting off air a moment ago, and you were saying it hasn't done anything for the last month, even with all the turmoil that we're seeing offshore. Perhaps we're going to look ahead then and say, what can we expect from the bond market going forward?
Right. So even while the rand has had its ups and downs in the past month, and we've had the risk on trade happening, the South African sort of 10-year yield has been hovering around 7.9%. Interestingly, the U.S. 10-year Treasury has been hovering around 2%, just oscillating around there. Looking forward, I mean, the key to bonds is always going to be your longer-term inflation outlook, which is going to be driven in this case by the rand, which is driven by the risk-on, risk-off trade internationally. So again, it takes us back to the international environment almost inevitably.
You look very hostile with your arms folded this evening, Andrew. Are you going to relax into the interview? I like it. Thank you very much.
I'm easing up.
All right. Now that we've got you warmed up, let's throw forward to your thoughts on inflation going forward in South Africa. Obviously, as you indicate, so key to your environment and where bonds are going long term.
Right. So the inflation outlook from the central bank and broadly from analysts is that inflation this year is going to average something around 6%, maybe a little bit more than that. And then going into 2013, start coming down pretty sharply towards the low 5% level, and even thereafter to 2014. So if you kind of take a 5 to 10 year view of inflation, you can see inflation running at around 5 to 5.5% would probably be the average of analyst expectations. So if you compare that to sort of your 10-year bond at nearly 8%, we have decent real yields in South Africa by comparison to sort of certainly the developed markets. So South African bonds don't stand out as a horrible holding, nor do they stand out as a fantastic buy. You certainly shouldn't lose a lot of money with them.
Andrew, international investors were quite a big factor last year. What are you seeing this year?
Right. Well, I haven't been watching the money flows so much in the last few days, but broadly, we haven't seen huge flows like we saw in 2011. It's been a bit more upsy and downsy.
What do you expect from international holders going forward? Do you think that they're going to start piling back into the bond story?
Look, it's the risk-on, risk-off trade. The reality is, by global standards, South African bonds are a relative buy. If you're holding U.S. Treasuries earning negative real yields on the 10 and even the longer-term bonds, negative real yields, and we have positive real yields, plus an emerging market, part of the BRICS, good fiscal and monetary dynamics in South Africa. In fact, I thought the budget was much better than people gave credit to the Treasury. South Africa really should be a buy for a yield pickup, but we just haven't seen that flood of money. I think there's so much nervousness about the European situation, an inability to segment the risks by global bond players, perhaps a bit of tunnel vision. They're trying to decide, well, after Greece, what next? And inevitably, that's going to be Portugal and probably Spain. This story is just going to keep playing out, and that has the risk aversion fairly high.
Andrew, if you were relatively positive around the budget and you say people didn't give Treasury enough credit, what are your thoughts on the financing of this infrastructure spend in South Africa? We didn't see much clarity on that line. The market wanted it, certainly a little bit more detail. And I remember our last debate on Sanral was pretty heated.
Well, okay, so there's two elements to the discussion. I mean, first, the government rolled forward its rolling 3-year infrastructure budget. I think they're budgeting now 845 billion rand for infrastructure spend over the next 3 years. The finance requirement, that the overall debt funding requirements by the government and the state-owned entities, the public sector borrowing requirement, which is the phrase I'm looking for, is going to be just over 7%, which is lower than it was over the last 2 years or so. And the numbers that have to be funded aren't really scary either. You're looking at net long-term debt issuance in South Africa of about 110 to 120 billion rand. These are not hugely scary numbers. So I'm not particularly concerned about the ability of SOEs to fund, nor of central government to fund. Sanral, of course, is a different discussion, and that has now been sorted out, thankfully, with some rationality, or a degree of rationality. I certainly don't think the central government should have chucked the 5 billion rand into Sanral. I think tolls should have been implemented as planned. Enough said. That's
because you live in Cape Town. We won't go there again. We won't go there. I'm waiting for the day you get tolls down in Cape Town, and then I want to revisit that discussion with you. Maybe you can break it up here. Fine. Kevin, jump in.
Andrew, just moving back to the international context, you've outlined South Africa's inflation outlook. Globally, what do you think of inflation, just to see that inflation differential?
Right, so I don't have a number. I mean, it's hard. It's global inflation. It's hard to put a number on that. But certainly from the current levels where it's been driven by commodities, oil, food in particular, I think the expectation is going into 2012 that inflation is generally peaking and moving back into the sort of sub 2% range in the U.S. And certainly you'd be talking about the core inflation in particular when you start talking about the 1.6, 1.7% area. But still, I mean, in an environment with really, really cheap money, central banks really leaning on the gas pedals quite a lot. The consumer and investors realizing now they are earning negative real returns. You're seeing car sales picking up, industrial production. The U.S. economy has a bit of wings to it at this point, I think. And there's a seasonal coming through because of the crisis impact in the fourth quarter of 08, and that echo through the data. But still, one has a sense that things like the home inventories are being worked off, home prices just about to turn upwards, pending home sales rising. You can get a feeling that things are going to pick up, and that has to be inflationary in the longer term. In other words, you're not going to see inflation going much further down from here. You're more likely to see it going up from here.
For the longest time, and through a couple of discussions that we've had, you have stated that you wouldn't touch US government bonds with a barge pole. Is that still your stance?
Yeah, it's a scam. I mean, you don't want to. The U.S. Fed is sitting on interest rates to keep them low, to get people to deploy risk capital, to invest in capital, to buy goods. They're running negative real yields for a reason. And I think there's also part of a plan to help Europe with its refunding of its debt problems by keeping US rates so low, keeping global rates low, so you can afford to, the nations of Europe can afford to refinance their debt at low levels. But let us be clear, it's a manipulation. Bondholders of US long-dated treasuries, and probably European bonds, by the way, as well, and I mean sort of core, German type European bonds, are going to have negative real yields for the next decade. I think it's a losing proposition, and really investors need to avoid it virtually at all costs. You got to take a view on whether you think the world's going to fall off a cliff, because equities right now, earnings yield sort of on a 10.6 forward PE, look to me as a much better proposition on sort of a risk view basis.
Interest rates in South Africa, let's bring it home. I know I'm jumping all over the globe this evening, but interest rates in South Africa, again, key to your story in the bond environment. What are you anticipating for the rest of this year? Flat and then ticking up 2013?
Right. So there's a fair amount of forecast uncertainty. So some analysts are saying that you're not going to see any bank rate moves until well into 2013. But the forward rate market in South Africa is now saying you might see a bank rate hike as soon as, let me think, sort of October, November this year, a 50 basis point hike. But it's forecast uncertainty. You just don't know. Right now we are also running negative real rates in South Africa. So you have to take a view. So let's say the world recovery continues, growth uplift, the tension of Europe passes, and you don't have any banking crises on the horizon, and you could actually see the economy start picking up to such an extent that the Reserve Bank does get back to a real rate environment in 9 months' time. I think most analysts say that you won't see a hike until early 2013.